Okay, let's jump right in. The Nasdaq.
Yeah.
Wow, just exploded up over 4% Tuesday, May 13th.
Huge jump.
Yeah, a really serious move
Yeah.
that officially pushes it into bull market territory, right? So more than 20% up since those April lows.
That's right. Quite the turnaround.
So our mission today really is to dig into what's actually behind this tech surge. What's driving it?
And it's interesting, isn't it? Because it doesn't feel like just one single thing. It's more like a few positive signals hitting all at once, finally cutting through the noise.
Exactly. And the two big ones everyone's talking about are, first, this new 90-day U.S.-China tariff truce that just dropped.
Big news.
And second, a little bit of good news on inflation, which seems to have cooled off slightly.
Just a touch, but enough to notice.
And you can see it in the big tech names, can't you? They're really feeling it. Nvidia, I mean, rocketed up 5.6%.
Yeah, massive gain.
And Tesla, too, up a solid 4.3%. They're really leading the charge here.
And if you sort of step back, you see how these two things directly tackle some of the big worries that have been hanging over the market, right?
Like what specifically?
Well, inflation sticking around, geopolitical tensions, those have been major headwinds. So any sign, even a small one, that those pressures might be easing, that's going to cause a reaction. A strong one, apparently.
Okay, so let's unpack that U.S.-China tariff truce first. This isn't just tinkering around the edges, is it?
No, not at all. Some of these reductions are pretty dramatic. You mentioned one example, tariffs on certain goods dropping from, what was it, 145%?
Yeah, staggering 145% down to around 30%.
Yeah.
That's a massive change.
It really is. And think about the ripple effects, especially for tech companies.
Who benefits most, do you think?
Well, anyone with big operations or sales in China, obviously. Chip makers, definitely. EV makers. Even cloud companies that rely on supply chains running through Asia.
Right. Suddenly costs could drop, competing in China gets easier.
Exactly. It's not just about margins today. It could genuinely change how they plan things long term.
And we're seeing that already in stocks like AMD, Apple, even Amazon.
Yeah, the market's reacting fast. Investors are clearly placing bets that this is a positive.
And Goldman Sachs. They called this a sentiment pivot point for the whole market, not just tech.
That's a really interesting phrase, sentiment pivot point.
What does that really mean in market terms?
It's like, okay, imagine months of worry building up. Trade wars, global growth slowing down, everyone's cautious.
Okay.
Then this truce happens. It's like a concrete signal, something tangible that maybe, just maybe, things are getting better. It breaks that negative narrative.
So it encourages people who are maybe sitting on the sidelines.
Exactly. They feel more comfortable putting money back to work. It's like releasing pent-up optimism, you know?
Okay, got it. Now let's switch over to inflation. April's CPI number, 2.3%. Just a tiny dip from 2.4% the month before.
Seems tiny, right? And just 0.1%.
Yeah, why such a big deal over such a small change?
Well, it's the direction that matters so much here. After months and months of stubborn inflation, even a tiny decrease feels like, well, like maybe things are finally heading the right way.
A glimmer of hope.
Kind of. It maybe suggests the efforts to control prices are starting to bite. And for investors worried sick about more Fed rate hikes?
It gives them some reassurance. Maybe the Fed eases off.
Precisely. It lowers that fear. And you might even get a bit of FOMO, fear of missing out, kicking in, pushing more money into the market, especially growth areas like tech.
Right. And remind us again, why is the idea of the Fed not hiking rates such a boost for tech stocks in particular?
Yeah, so that slight dip in inflation suggests maybe the Fed feels less pressure to hike rates aggressively.
Okay.
And that is crucial for tech because these are often growth-focused companies. They borrow money, right, to fund R&D, expansion, innovation.
Sure.
Lower interest rates mean cheaper borrowing, simple as that, which boosts their potential future profits and makes them look more attractive to investors right now. It all connects.
Okay. But here's where it gets, I think, really interesting. The party seems a bit exclusive.
Exclusive is a good word for it.
I mean, the gains look heavily concentrated in that small group of giants. The Magnificent Seven.
Yep. Nvidia, Microsoft, Apple, Meta, Alphabet, Tesla, Amazon. The usual suspects.
So what does that tell us? When the gains are so focused, so narrow.
It's a critical point, actually, that narrow breadth. Because while the Nasdaq headline number looks amazing,
Yeah, up 4%.
the reality for lots of other companies might be very different. They might not be getting that lift at all.
So it suggests the market's excitement is really riding on these few huge players.
Pretty much. It maybe shows a lack of broad conviction across the whole market. investors are still being quite selective, piling into the perceived winners.
Which naturally brings up the big question, can this last? Can this kind of narrowly focused rally keep going?
Are there, potential potholes ahead we should be watching for?
Yeah, exactly. Sustainability.
Well, you're right to ask. Because while this initial burst is understandable, you've got strategists like at Barclays, Morgan Stanley, already putting out warnings.
Warnings about what? A pullback?
Yeah, basically saying, hold on a sec, they're pointing out risks. Like, what if this U.S.-China truce is just temporary? What if it falls apart in 90 days?
Right, that's a definite risk.
Or what if the next round of earnings from these big tech leaders,
Wow.
what if the guidance doesn't quite live up to the hype that's now baked into these higher stock prices?
So expectations might be getting a little too high.
Could be. So potential triggers for a reversal. Yeah, the truce dissolving is one. Disappointing earnings guidance is another big one. If future outlooks don't justify the current valuations, investors could get nervous fast.
And are there specific issues facing some of these Magnificent Seven companies right now? Weak spots?
Oh, absolutely. They each have their own challenges. Take Tesla, loads more competition in the EV space now that's putting pressure on their profit margins. Nvidia. Amazing run, incredible company, but its valuation is, let's say, very high. Any hint of slowing growth could hit the stock hard.
Right. Price for perfection, almost.
Kind of. And then you have Meta and Alphabet. They're constantly dealing with regulatory hurdles, especially over in the EU. That could always throw a wrench in the works for their plans.
So it sounds like, I don't know, like we could see this rapid run-up, this sort of melt-up maybe, and then things just pause for a bit. Market needs to catch its breath.
That scenario, a melt-up followed by consolidation, is definitely something to keep in the back of your mind. It happens.
Explain melt-up again quickly.
It's when prices shoot up really fast, driven more by that fear of missing out by positive sentiment than necessarily by just the underlying company fundamentals getting suddenly that much better.
Got it. And then the consolidation is the pause, the reassessment.
Exactly. The market kind of stops, digests the gains, investors take another look at valuations, and things might trade sideways for a while or even dip.
Okay. So for you listening right now, trying to make sense of all this, what are the key takeaways? What should you be thinking about or maybe adjusting?
Well, I think in this kind of environment, the old advice about diversification, it's more important than ever, really.
Don't put all your eggs in one very hot basket.
Exactly. And try to resist that urge to just chase these short-term gains, the hype. Focus instead on companies with genuinely strong businesses, solid financials, a clear path for growth over the long haul.
Even within tech, are there areas that still look interesting beyond just the absolute biggest names?
Oh, for sure. I mean, think about the infrastructure behind AI. The companies actually building the hardware, the data centers, the software platforms. That still feels like a long-term growth story.
Right, the picks and shovels of the AI gold rush.
Sort of, yeah. Cloud services, too, still fundamental. And semiconductors, generally, they're crucial for everything.
Yeah.
Those areas still seem promising.
And what about just general strategy right now? Any thoughts there?
Well, maybe it's not a bad idea to keep a little bit of cash on hand. Just having that flexibility. If the market does dip or pull back, you're in a position to potentially buy things you like at a better price.
Okay, keeping some powder dry.
Yeah. And also keep an eye out. If rates do stabilize, if inflation keeps cooling, maybe later in the summer, we could see the rally broaden out a bit.
Beyond the Magnificent Seven.
Yeah, potentially into other sectors, maybe even small cap stocks start to participate more. That rotation is definitely something worth watching for.
Okay, good point. So let's try and wrap this up. We've seen this big Nasdaq surge.
Driven mainly by that China tariff truce and the slightly cooler inflation number.
Right, which has been fantastic news for the big tech players, the Magnificent Seven, who've really led the charge.
But we've also flagged that the rally is very concentrated.
Very narrow, yeah.
And there are real questions about whether it can keep going at this pace, given potential risks like the truce ending or earnings not meeting high expectations.
Exactly. It feels like the market's enthusiasm is really balanced on these few key players and positive signals holding steady.
Yeah, that sums it up well. The durability of those catalysts and the actual performance of these leaders are key going forward.
So here's a final thought then for you to mull over. Given this concentration, given the potential for shifts, what might be an overlooked opportunity right now? Or maybe what's a potential blind spot in this current fairly optimistic market view? Something to think about.